Earl, I got to meet about 2 years ago, right after the conference on public banking that took place here. I hadn't known about it, otherwise I would have attended. So he is extremely modest and therefore gave me just a few lines, unlike the two other speakers who are terribly arrogant and self-righteous. But at any rate, co-founder and chair of Rocky Mountain Public Bank Institute, that's us, co-sponsor of ballot initiative to establish a state-owned bank in Colorado, attorney with, listen to this, diverse civil litigation experience, including toxic torts, commercial litigation, real estate, and antitrust law, former board member of the B Change of Colorado, and former lecturer in law. So that's something of a mouthful. But I won't go any further except to read you a piece from the London Times around the 1860s, which were the times of great, great change in the United States because the corporations and were taking over with the robber barons, and there was a great deal of turmoil. So the issue of greenbacks came up for consideration. That is to say, the idea that instead of banks creating money, it would be the charge of the government to create money, right? And therefore use it in considerably more appropriate ways. And so the London Times of the time wrote this: if that mischievous financial policy which had its origin in the North American Republic during the late war, so here's a civil war and they call it the late war, in that country should become indurated down to a fixture. So I, even having gone through an English school, didn't know what indurated meant. So I looked it up, and guess what it means? It means to become hard. Another more metaphorical meaning was to become fixed or established. So if this policy should become indurated down to a fixture, that is to say, to become a policy, then that to become a reality, then that government will furnish its own money without cost. It will pay off its debts and be without debt. It will become prosperous beyond precedent in the history of the civilized governments of the world. The brains and wealth of all countries will go to North America. That government must be destroyed, or it will destroy every monarchy in the globe. That's how serious the top newspaper of the time took this threat. So, welcome to the threatening group.
Thank you, Alec. The first question is, what is a public bank? Well, it's pretty simple. It's like any other bank, except that the money of a city or county or the state, say of Colorado, instead of being put in a private bank, which means typically one of the major banks, puts it all in the government-owned bank and run bank. And all of those assets are then used to loan money into the community and meet various community needs, which typically are, and today, are not being adequately met. And all of the income, the interest income on that money, comes back to the taxpayers, to the citizens, to the people of that community. And As a result, they're able to build up that income and strengthen their economy and have a very full and strong community and economy. How does it differ from a private bank? Well, it's a very, very significant difference. In fact, there are many of them, which we will get into some. I hope most of you picked it up, but there's a memo, a one-page memo that lists 22 advantages of a public bank for a community. And you might want to look at that or have that available during this talk. You get a big bonus for coming here because when we did the announcements, you may notice it only said 17 advantages. Now it's up to 22. The big difference is that in a private bank, the shareholders who own the bank and the employees and the officers who run the bank are working for the shareholders. Their obligation, their legal obligation is to the shareholders and to maximize profit for those shareholders. And there lies all of the difference. Would you rather have a bank that is serving the community, and that's their obligation, or one whose obligation is to maximize profit for shareholders and officers who have obligations that conflict in so many ways with the interests of the community? Next question is, what is money? We're going to adopt a very simple definition, and this is one that has been recommended by people like Ellen Brown and other forward-thinking economists, Stephen Zarlenga. Essentially, it's a medium of exchange, and that's as distinguished from a commodity such as gold or silver, something of value. There's a problem when that becomes the definition of money, in that wealthy people can then corner the market on that commodity and manipulate it to their advantage and to the disadvantage of the rest of the community. In addition, those valuable metals are scarce in supply, and so you can never have enough money if those are your definition of money. How is money created? And this is a, Alec, could I borrow your copy of Web of Debt there? Yeah. Okay, thanks. Thank you. Money is created by banks when they make loans. Roughly 97% of our money is created by banks when they make loans. A quarterly circular of the Bank of England from 2014 basically describes the process as creating money that did not exist before. Some people have called it creating money out of nothing. And that's how it's done. How do they do it? Well, under standard double-entry bookkeeping, generally approved under generally accepted accounting principles, when a borrower makes a promise to pay to a bank, that promise to pay is recorded in the bank's books as a new asset. Let's say it's a $300,000 house. A new asset of $3,000 of money that did not exist before. That's what that promise to pay is. And the check that's written that then may become a deposit in that bank or another bank becomes a liability or a debit on that bank, whereas the borrower's promise to pay is a credit. Also, under standard banking principles, banks are permitted to lend up to 10 times the amount that they have as capital reserves. And this means that they can lend out much more than their reserves and can earn quite high returns on their equity. The Bank of North Dakota over the past 13 years has averaged at or close to 20% return on equity per year. I talked with a community banker, a man who ran a community bank for many years here in Colorado, and he said their bank averaged close to 20%. From the way he described it, his bank was run more efficiently than many private banks. And the question is, should all of that income that is made on our money, this is tax money that is paid in by all of us to the community and other revenue, should all of the income on that belong to us, or should we give it away to private banks to use for their benefit and for their uses? I think the answer is not hard to come by. Also, a consequence of money being created out of nothing, if you will, or money that didn't exist before, is that when the money is repaid, so month by month, to the extent of those repayments, that money actually disappears, ceases to exist. And as John Kenneth Galbraith pointed out, if we had no debt, no national debt, no other debt, we would have no money. And that, of course, brings up the other way that money can be created, which is when a government actually prints money. As Alec mentioned, greenbacks. That's how they were done. They printed money and spent it into the economy. Today we're talking about public banking, which involves lending, which is another way that governments can create money. But our national government borrows most of the money to run government from private banks. And as Wright Patman, who was chairman of the House Banking Committee for 10 years, said, why would any government borrow all of its money to run government that it could create itself without having to pay interest and without borrowing? He basically said that's insanity. If you will turn to the list of 22 advantages of public banks in Colorado, I won't have time to go into all of them in detail, but they all stem from number 16. Provide undivided loyalty to the public interest rather than to private shareholders. It's an old saying in the Bible, you can't serve two masters. And that's a huge problem that occurs when we put all our money in private banks. Let's see what those are. Number one, facilitate full employment at a living wage. Until you reach full employment, it's argued by Ellen Brown and others, when you spend money to create new goods and services, you are not going to cause excessive inflation. You're going to keep it under control. And we don't have full employment at this time. This economy nationally has about $3 trillion in it less than it had back in 2008. And that is partly why we have so many people who are earning less, do not have full-time jobs, do not have benefits they used to have, do not have the pensions that they used to have, and don't have the Medicare and other benefits that have been cut. Benefits of all kinds. Those are all consequences of this massive reduction in the money supply in our economy. If we had publicly owned banks, much of that could be restored. Number 4 is one of these very significant ones. Prevent recessions and bubbles and inflation because public banks lend counter-cyclically. In 2008, North Dakota, like the rest of the country, experienced the pressures of a nationwide recession, the Great Recession, and yet they experienced a record surplus that year, and they have each year since then. How did they do that? Well, what countercyclical lending means that because the bank has its obligation to the community, when the national economy declines, they increase their lending or support the local economy or government. And that's why North Dakota did not suffer a decline in 2008. Some have argued it's because of the oil, and there has been a lot of oil in North Dakota, but there was also a lot of oil in Alaska and in Montana. And yet those two states both experienced high unemployment, and they also experienced budget deficits. In addition, just 2 years ago, we had a marked decline in the price of oil, which one would expect, well, that's going to cause, as it did, economic decline in various areas, particularly in one where there's a lot of oil. But North Dakota, again, experienced a record year. Yeah, and also the income from their oil did not really kick in until 2010, 2 years after the Great Recession. So any argument that it was the oil that is responsible for the prosperity of North Dakota and its bank is mistaken. Number 8, increased lending to small and medium-sized businesses. This is a big factor, and we have some small businessmen here who are very interested in public banking. The major banks are not good at lending to small businesses. Public banks are. The Bank of North Dakota makes a lot of its lending to small and medium-sized businesses. And they have done that through the community banks in North Dakota. These are the small, local, private banks. The banks that are run by people like George Bailey, the annual Christmas time hero in the famous film that we've all seen. These banks do the actual determination of creditworthiness in North Dakota for the Bank of North Dakota. They meet and know the customer and treat them very well. And then that's reviewed by the Bank of North Dakota before the loan is made, and sometimes they share in the amount of lending. Sometimes the Bank of North Dakota will guarantee the loan or issue a letter of credit that enables the community bank to get a lower interest rate or to undertake a larger loan that they couldn't do otherwise. The consequences of this are very beneficial for North Dakota, its citizens, and for these community banks. What is that benefit? Well, they have not had a single bank failure in North Dakota for at least the last 13 or 14 years. Unlike no other state in the country, they have 4 times the national average of community banks as any other state. And I was handling a banking litigation several years ago, and this is after the 2008 crash. And I saw an enormous difference in the behavior of the community bank involved in that litigation, which treated its customer very well, and that of one of the major banks that gave them the most egregious treatment, ignoring their requests, ignoring their questions, and not honoring their rights to try to redeem their property. It was a nightmare for them and extremely stressful. And that's one of the advantages of preserving the role of private community banks. Number 12, and I mentioned the rather large return on equity that a public bank can return and should if it's properly run. As I mentioned, Bank of North Dakota averaging 20% return on equity over the past 13 years. Number 13, reduce the cost of public infrastructure projects by up to 50% or more. That's the portion of a project that consists of interest. when you pay that interest over a period of years, it can add up to 40%, 50%, sometimes a lot more than that. And if the project runs over time, why, that interest piles up, and you can have a project amount to many times, several times the original cost. California has projects where Major Bridge and projects like that are double. You know, instead of $10 billion, it's $20 billion. That's our money that we should not be wasting through these means. Number 14, respond more quickly and effectively to natural disasters. We had a horrible flood here in the Boulder area, and it took longer than it should have for many of the people there to be helped. In North Dakota, in 1997, there was a flood of the Red River, and the Bank of North Dakota immediately came to the aid of the most distressed residents. They put a moratorium on payments of mortgages. And issued immediate loans for repair and that sort of thing. They only lost 3% of their population in the area affected by the flood, whereas in Grand Forks, Minnesota, just a minute across the Red River, they lost 17% of the people in those same badly flooded areas. Number 18 is another critical one. Eliminate substantial and excessive fees paid annually to Wall Street. Paul McCree will have more to say about that, but that is turning out to be extremely costly, and those costs are not always fully disclosed. Number 19 is prevent privatization and privatization and cuts in essential services. The Route 36 to Boulder and other projects are called, public-private partnerships, and those could be avoided by having our own bank. And finally, how many of you are familiar with the Tabor Amendment in Colorado? Okay. Well, it's a major part of the privatization and the cutting of services because of that amendment that causes what's called ratcheting down and reducing of government expenditures in spite of need and even the availability of funds. Funds that are earned by that government are required to be paid back to taxpayers and cannot be used for the benefits. Well, if under the Tabor Amendment, if Clause 2D is used and it's made a Tabor enterprise, this is a self-sustaining enterprise, that money does not have to go back to the taxpayers. It can be used for government as long as it is government run and owned. Less than 10% of its income comes in any year from state or local government in Colorado. And number 3, it's authorized to issue revenue bonds. Does not have to issue them, but it must be authorized to issue them. I want to mention, if anyone questions whether public banks are possible to be owned by cities, in Germany, there is a group of publicly owned savings banks, all owned by cities. There are 1,500 of them, and they have been very successfully run for 200 years. And they have formed the backbone of Germany's economy and the backbone of lending to small and medium-sized businesses. So we know without question that cities and other governmental units can safely and effectively run publicly owned banks. Thank you. What is the difference between a bank and a credit union? The primary difference is that a credit union is owned by all its members, who are typically equal in rank. It's not according to the percentage of ownership. And they, with that equal vote, they function somewhat similarly to a community or a publicly owned bank in that they serve the whole community of owners. In a private bank, the shareholders are the owners, and they vote according to the amount of money in shares that they own. And so a few shareholders who own most of the shares can dominate that bank and operate it in their own interest rather than that of employees at all levels. So there's that difference. Plus, credit unions typically have a much smaller authorization for maximum lending types of loans. Some of them can't get into real estate loans even very much. Those are the main differences. The question is, one of the benefits is the ability to reduce taxes. That's very true. In North Dakota, several years ago, they actually reduced taxes by $900 million. That's a lot of tax reduction. And the greenbacks we mentioned, there's a community in Guernsey, which is an island in the English Channel, that has been using the equivalent of greenbacks, printing their own money without borrowing, and spending it into the community for new goods and services for 200 years. They have experienced virtually no inflation during that time, even though there's much more money now in that economy. They have a population of 62,000. Can a publicly owned bank, owned by a city, county, state, use fractional reserve lending? Absolutely. They would be chartered just like any other bank in Colorado. They would have the same rights and privileges, yes. And that's why it would be capable of producing a very high sustained income. And one of the things on your list of 22 advantages is that public banks tend to be very economically run. They don't have advertising, they don't have ATMs, they don't pay outsized salaries and golden parachute bonuses, things like that. And so they have a chance to be even more profitable. And because it's our money, why should we not be able to take advantage of those better operating methods? How do you avoid the moral hazard of corruption that occurs on Wall Street? Well, number one, the bank is transparent. That's also listed on your list. The Bank of North Dakota reports its accounting publicly every year. You can look at the last 15 years or so of their annual reports and their detailed financial reports every year. Their officers are all publicly known. They have at least 2 tiers. They have an advisory board that has experienced bankers who have experience and participation in banks that are majority owned by residents of North Dakota rather than by outside banks. And they have people from other parts of the community. And they are authorized by statute to advise the bank regularly on processes. And all of these things are made and can be made public. So they've been transparent and accountable in that way. And the bank has been operated for many years without the slightest taint of corruption and fraud. And that was seen also with the Reconstruction Finance Corporation, which was actually a United States-owned bank that operated from 1933 to 1945 and on into 57, not the slightest taint of corruption. And that put $35 billion into the U.S. economy, and at the time was the largest banking corporation in the world. There are many other examples, but it's very important to make sure that the bank is transparent and accountable in these ways.